Welcome to the Warlords of Wall Street. I suppose you might be wondering what happened with Friday's session. Well, it turns out the manufacturing PMI, the inflation data that came out, was a little better than expected. That put the market in a decent frame of mind. We also saw the continuing tightening between the point inversion between the 2 and the 10-year. I see that as a positive, nearly painful sign of the economy returning back to its normal axis. If anything, we ought to see the inversion and the ratio going the other way. Obviously, you should get a higher yield for putting your money to work in a 10-year security than you do a 2. This is going to become a continuation in a painful process, but it is also confirmation that since that spread was as much as a point not so many weeks ago, that the return to normalcy, it's a process that's happening. So we're very pleased to see that. As a whole, it also speaks to all the drama that seems to be all the headlines of the paper, and we've been covering it here for a couple of weeks now. It's the regional banks. Everybody continues to be antsy about what the books are looking like throughout the regional banks, and we got some feedback from one of the last podcasts that we did, and we wanted to expand on it a little bit and maybe try to put it in a little different perspective and maybe tell the story in a little simpler reason. When a bank makes a loan, as SVB did, we commented on them. A loan it's a speculative investment on the bank's end. Even though they do their due diligence, they do their underwriting, the fact of the matter is that there's nothing theoretically safer on earth than a U.S. government bond. And if you're putting your money to work in a U.S. government bond and you're making 3.5%, then that is always going to be the argument on one side of the scales versus that you're going to go ahead and loan somebody the equivalent amount of money in credit cards. Now, although a credit card may end up earning you a 15 to 20% interest rate as opposed to making a 3.5% return, over here with the government bond, you're borrowing your money at 3.5. If you're the bank, you're lending it out to people in the form of an unsecured credit card, and you're getting anywhere from 15 to 20 odd percent back. Well, that spread is very, very nice, to where the bond at this particular moment is almost a break-even proposition. So banks, of course, would love to always make loans in the way of from automobiles that might be in the 6, 7, 8, 9% range, commercial loans, which might be in the 6, 7, 8% range, and that allows them, if they're buying their money from the Fed window at 3 and change, they're going to be able to double, triple their investment. Nothing is quite like a credit card, of course. But when you're making this type of an investment, the federal regulators expect that you're also going to be playing conservative to offset that risk on the other side. So they expect to see the bonds. And a year ago, when they were making, let us say, a commercial loan on a building that they thought was a really good investment, and there's nothing wrong with the building, it was a good investment. It was a smart loan to make. But it was made at the prevailing rates at the moment, and their alternative to offset that risk was a government bond at whatever maturity they decided to select, but it wasn't yielding much more than 1%. That's what their dollar bought at that moment. Now, here we are a year later, arguably, and now you've got the yields, not just 1%. Well, goodness gracious, they were flirting with 5 not a hot minute ago, and yet, now, because that's what a dollar will get you, is a 5% return, then what does that make the bond worth that they bought not just a year ago when the dollar only got you a 1% return? Well, naturally, that means that in a free trading market, that bond that only yields 1% is got to be less attractive than a bond that yields 5%. If the dollars were even, then of course you're going to take the 5%. Well, the banks don't have the luxury. They could have, would have, should have managed that position a little better, but the fact that they didn't, banks typically just hold to maturity. It's a very conservative way to do it, and I as a former commercial banker and a commercial lender, I completely understand when the Federal Reserve and the regulators went in there, and at the time they said, sounds good to us. Now, my only criticism now going forward is things started to change, especially aggressively over the last year. And the federal regulators, they're going to give the excuse, well, we just don't have enough manpower to go into all these banks, look at all their books, and recognize that this is a problem, which I say horseshit to, is because everybody knew that this had to be a problem, but nobody wanted to touch that third rail. Nobody wanted to go in there and tell the big banks or even that of the regional banks to say, you've got a major problem brewing in your portfolio. You're going to have to start trading these bonds, even if you're taking a little bit of a loss, but you've got to put yourself in a position to where you know that the Fed just told you they're going to continue to raise interest rates. You're going to have to get out in front of this thing, and you're going to have to manage your portfolio better, because if you don't, and you continue just to sit on a 1% bond, and these rates are going to the terminal rate of a 5% range, give or take, which is exactly what the Fed told you it's going to do, then you're going to be way underwater on these bonds. And you've got a big chunk of your portfolio, your assets are invested in these bonds. If these bonds go underwater, and they are guaranteed to go underwater from a par value perspective, that's what you're going to do. You're going to mark it to the current market, and you're going to have to mark your bonds down. If that happens, then your books look like crap. You don't have the same equity and reserves 5 minutes later that you did 5 minutes before, because now you're recognizing that this particular asset isn't worth what you paid for it anymore. And it's getting less valuable every day as they continue to raise interest rates. What are you going to do about it? Sadly, it appears the federal regulators didn't have these conversations with anybody for the most part. And that's what concerns me. It's not so much that it's the bank's problems. It's the lack of courage on our regulators' parts. But why should we be surprised that the government's employees, those from everything from the Securities Exchange Commission all the way down to its banking regulators, are utterly incompetent? But this is the situation that we have to manage through now. We know that they're incompetent. Is there anything that the government does well other than waste money and do stupid shit? But that's what the government does. So now that we know that this is the situation, what is a bank to do? Well, the bank only can say, listen, I'm going to have to, since my financials are looking worse than they ever have for a while, nothing on our part. The Federal Reserve did it to us. They're the ones who took rates from 1 to 5, not our fault. But how do you manage through this if you're a competent banker? Well, that means that you're going to have to go out there and you're going to have to look for loans, because you're going to need quality on the books. So you're going to get pickier than you ever were on the loans. You're going to be tempted to want to go for higher interest rate returns, because you're going to need those excess profits to kind of fill in the hole that your bond portfolio dug for you. So there is this catch-22. Do you go for the higher interest rate stuff, or do you continue to stay conservative? I'm going to guess that it's going to be a mix of both. But with that happening, that means the banks are going to be a little tougher to deal with if you're a businessman to go in there. They're going to be looking at your financials because they can't afford to make another mistake now. There's in a normal course of business, you expect a certain percentage of your portfolio to end up defaulting, end up having collection problems, that type of thing. But right now, I'm sure they're hypersensitive to that, and it's going to be harder to get a loan today than it was not just a few weeks ago. Well, having said that, if a small business can't go in there and get the types of loans that it needs to continue to expand, what is that going to do to its potential revenue going forward? Well, that means that potential revenue may not even occur. They may not be able to generate it. Well, if that's the case, then growth slows. If growth slows, earnings slow. Earnings slow, market doesn't like it. Market likes to pull it back. And that is exactly what the market is positioning itself for right now, is an inevitable slowing in corporate growth and profits going forward through the next several months, probably, while they get this interest rate debacle taken care of. Now, whether that works or not remains to be seen. But if all of a sudden, we're affecting borrowing, we're limiting growth, earnings. That means that's got to continue to put pressure on the economy, which six of this, half a dozen the other. What comes first, the chicken or the egg? Hey, does that mean that the government has to continue, the Fed, I should say, continue to raise rates because now the economy is starting to slow down? Well, they can't. They really can't. And if you ended up continuing to hit a softening economy, and that's what we're looking at, well, then you may very well tip it into a recession. I think we're in a very mild one right now, a slowdown. That's all that recession means is slowing down. But I don't think we're in a crisis situation. And I think we saw the last, even though Powell was beating his chest, that there's probably another 0.25% coming here in short order. I don't buy it. I don't buy it. I'm thinking that he is done right now, but he can't say that out loud. And I think we're going to be okay. At the end of the day, I think we're going to be okay. I think that although inflation is a little sticky, it is starting to come down slowly but surely. I think we're in the sixes and pretty soon we'll be in the fives. It's going to end up working. But it's a hot story. And we all know that the talking heads on TV, fools that they are, they're just looking to go for the ratings. So they're going to beat this drum until you just can't take it anymore. It's not unlike it was when, Russia came into Ukraine. There was serious drama around that, as ought to have been. They needed to tell the world that this was happening. But then you got into the spin cycle. Oh, that just means that oil is going to go through the roof, and it's going to mean that if there's a brutal winter, that means natural gas is going to go through the roof, and all of these incredibly bearish narratives starting to get spun, but they make for heavy drama, they make for good sound bites, and that gives the talking heads a lot of fodder to discuss on air, and that's what drives ratings. It's unfortunate, but they're not doing the market any favors. And the reality is that, keep this in mind when you're listening to the advice of those that are on television. You have to wonder, it's nothing more than an anchor sitting there being fed tidbits through their earpiece. They don't know what's going on. They're not so very clever. They're just their producers are telling them what to say. And half the wonks that are sitting on the desk, including the Kramers of the world, they aren't the greatest money managers in the world. If they were that good, they would be sitting behind the desk of their own particular firm, their own particular hedge fund, and they'd be too damn busy to spend the whole day in makeup and being on set with CNBC telling you what they think. I'll tell you what you need to do. The next time one of these guys has an opinion, including Cramer, and he loves talking about his travel trust, and he loves bragging about all the places he goes and how expensive his suits and ties are. Ask a question. How much is his average rate of return on his travel trust? What is the historical rate of return on his travel trust? I think you'd be shocked to learn that he can't even keep up with the S&P 500, and yet CNBC is touting this clown as one of the great investment minds of our time. Little secret to be shared. If you don't remember, you can probably Google this and find it out. He was guilty of insider trading a great many years ago, and he ended up telling on a whole bunch of people to keep his hind end out of prison. So, how good is Cramer? I don't know how good Cramer is. I know he's not as good as the average wonk that's running an S&P index fund. So, with that, I've got nothing else to complain or bitch about today, but as we always say, the market's going to continue to be volatile. Keep your powder dry, take your profits where you can, and be safe out there.